Here's what's coming up on Strategic Wealth with Matt Dickett.
They'll say, Matt, I don't understand what's happening. I can go talk to 3 or 4 or 5 different advisors and get 3 or 4 or 5 completely different opinions. Why is what is happening?
Now, there is no right or wrong strategy when it comes to income planning. There's definitely pluses and minuses to whatever strategy that you choose to use. Now, 2 of the most popular strategies. This segment, I want to talk about the different income strategies that are out there and available for you to use in your retirement. Now, there is no right or wrong strategy when it comes to income planning. There's definitely pluses and minuses to whatever strategy that you choose to use. Now, 2 of the most popular strategies that are out there is going to be the annuity strategy and then the interest and dividend strategy. Now, these income plans are becoming more and more important right now because pensions have pretty much gone away. Now, if we were looking 10 or 20 years ago, then this was just kind of gravy to add on to your income plan. But now that pensions are almost out of the equation, for those lucky few that still have them, that's fantastic. This is just an additional income for you. But for those of you that don't have that pension plan, it's so important to make sure that your retirement income plan is strong. So let's compare the 2 of the most popular ones and look at some of the pluses and minuses of each. So when we talk about annuities are guaranteed income that will last a lifetime. So they work very much like a pension in the fact that it doesn't matter if you live 30 or 40 years in retirement, you have no risk of outliving your portfolio. So when it comes to income guarantee, annuities have a yes. When it comes to interest and dividends, now this could be a portfolio that's comprised of preferred stocks, or you could even be using bonds for this type of income. There's not going to be a guarantee there. So when the market is doing well, then you're doing well also. When the market starts to fall, then you could potentially suffer some losses or even have to lower your income. When it comes to interest income off of bonds, things of that nature, that's going to be highly interest rate sensitive. So the income guarantee on the interest dividends is going to be a no. The next one, so principal protection. As far as annuities go, they're completely protected. So, depending on the type of annuity that you use. There are some annuities that are going up and down with the market, but the ones that you would use most efficiently for your income plan are going to be protected from downside. So this is going to be a yes here. With interest and dividends, again, the market is going to determine what type of income that you have, and it's also going to determine the principal that you have left in the account. So this is going to be a no here for interest and dividends. Now, flexibility. When you set up an annuity and you start taking an income from that annuity, well, you're pretty much locked into that income for the rest of your life. Now, you do have access to a percentage or a little more than what you're taking income-wise, but then that's going to affect you going forward for the rest of your life. So when it comes to flexibility with annuities, I would put a no there. They're not real flexible. Where the interest and dividends, you have all the flexibility you'd like. So if you wanted to go in and pull out more money or you needed to increase your income, then you could potentially take more risk. But remember, you don't have any guarantees there and there's no principal protection. So with more risk could potentially mean more loss. So although it is flexible, you have to be a little bit careful when you're in retirement. Now, when it comes to market loss and impact, with the annuity strategy, it doesn't matter. So when the market starts to fall, of course, you don't like it, but it's not going to affect your income in the least. So the market loss or impact on your income, there's not going to be any at all. So no impact. With the interest and dividend strategy now, you're gonna feel that. So if we start to see substantial loss in the market, like a year, let's look at back in 2008 when the market was down 40+%, well then it's likely that your income was affected as well, or the dividend income especially that you were taking off your investments. So there's going to be a yes, so it's going to be impacted. So if you have questions about which one of these strategies is going to fit you the best throughout your retirement, please feel free to call our office and or visit our website.
When you have confidence in your retirement future, you can live the life you've always imagined. Because of planning, you now have time to reflect on the wonderful memories of your life. You and your spouse finally have the luxury of leisure time together. To spend fun times with your grandkids, sharing the joy of their excitement about life. Smiling at the thought of quality time with your children and of picking up the check. At last, you have time to breathe and rekindle the love of your life. Why? Because you imagined what could be. You planned for retirement. So today, you own your future. Imagine what's next. Plan today, own tomorrow. Call Strategic Wealth Designers, 502-412-3354.
On this week's segment of Strategic Wealth University, we're going to be looking at a concept that we use called the brokerage triad. Now, what is the brokerage triad? The brokerage triad is a triangle philosophy of a managed money portfolio and what its objective or the managed money portfolio's objective should be for someone who is near or in retirement. Now, a managed money portfolio is a custom tailored portfolio with all different types of investments to fully capture the growth potential of the investing world. Now, with our portfolio management, the brokerage triad acts as a largely governing principle. Now, the brokerage triad is named for its shape, the triangle. The triangle is geometrically the strongest shape, and no one side is more important than the other. All three sides must have the same size, or in this instance, the same amount of importance must be maintained in order to keep the triangle or triad together. Now, the bottom side is safety. For structuring portfolios, safety comes first. In order to successfully build a portfolio, safety has to be included. Now, how do we create safety? We can increase safety or reduce risk by diversifying where our investments are in the market. But that reduces risk. It doesn't eliminate it. How do we eliminate being on the bad end of a nasty stock market correction? A stop loss can be an effective remedy, and for our in-house portfolios that we do have stop losses. Now, to simply explain a stop loss, once the price of a stock gets to a certain point, the investment is sold out immediately to avoid riding the roller coaster of a market correction. Now, this is the bottom of our triad, and it acts as our anchor. The second part of our triad is growth. Everyone wants growth, but where does growth come from? Now, growth, based on history and back testing that we as a firm have done vigorously, comes from equities or stocks. No other country or stock market index has performed as well as the United States. Now, with the growth potential of an emerging or developing market and the institutions and infrastructures of a developed world, we can potentially find great upside in the market. Now, this represents one side of the brokerage triad. The other and third side represents asset allocation. Now, we will go over the concept of asset allocation kind of on a high level. Now, asset allocation is simply defined as where each individual investment is located in the portfolio and what percentage it represents. Asset allocation is the most important part of building a successful long-term portfolio. Putting all three of those sides together, we then capture our brokerage triad, with safety on the bottom and growth and asset allocation on the other sides. Now, while the sides of the triangle are important for building the foundation, the inside is just as important. Inside of our brokerage triad is one concept, and that's investment principles. Without disciplined principles, a portfolio can crumble. Inconsistent decisions can be detrimental to a portfolio, and having a clear devised plan is an imperative. Anyone working with a financial professional should definitely have heard some example of these three things and how they work together. This is something that we see to be a vital part in all of our in-house portfolio management and must be centralized around your portfolio management. Now, if you would like more information on the brokerage triad or Strategic Wealth Designers in-house managed portfolios, please give our office a call or feel free to check us out on the website.
Thanks again for tuning in to today's show. I have to tell you, Dustin and I have been receiving more calls than normal lately from folks like you because people are concerned with what's happening lately in the stock market. They've simply heard from their stockbrokers to stay the course, don't be concerned, but we're definitely seeing a reason to get a second opinion. Now, a lot of that it comes down to having a plan.
Yeah, unfortunately, we've seen a majority of cases lately that people have done a great job saving for retirement, but they and their advisor don't really have a plan as to how to structure their portfolio in retirement.
Yeah, and this is especially the case when it comes down to structuring their portfolio for income. Studies today show that if you remain in the typical balanced portfolio, the appropriate withdrawal rate is 2.7%. So if you had $1 million, that's only $27,000 per year that you should be drawing in retirement. That just seems crazy.
Yeah. When we're structuring a portfolio during retirement, you're looking at closer to 5 or 6% withdrawals throughout retirement. That's why we encourage you to give us a call for a complete retirement review.
Yeah, we can take a look at your current portfolio structure and let you know what kind of yield you're accruing, let you know what kind of risk you're taking, and much, much more.
We'll spend some time talking to you about how to appropriately structure a portfolio during your retirement to generate an income where you don't have to lose sleep when the market isn't cooperating.
We also can't stress tax planning enough. A majority of people who have saved for retirement have their assets in retirement plans such as IRAs, 401ks, and etc. And guess what? During retirement, these are your most highly taxed assets. So we feel that it is our responsibility for our clients to find the best strategies to withdraw those funds at the lowest possible rate, or when the right opportunity rises, to shift those funds over to a tax-free asset. So again, we welcome you to give us a call for a free, no-obligation visit for your complete retirement review. We look forward to sitting down with you soon. When meeting with individuals or couples, quite often in the office, a question that will come up is something that relates to wills or trusts, estate planning, really in general. And although we are not estate planning attorneys, we know enough to be helpful. We have, as a firm, estate planning attorneys that we can refer our clients or potential clients to get expert advice. But there are a few general recommendations that I typically make. You know, in my opinion, not everybody needs to have a trust. A lot of times it makes sense to establish that. It really depends on what your goals and objectives are. If you have a pretty simple situation, whereas you were married to the same spouse, there's no mixed kids within the relationship from previous marriages, if all of your property is owned within one state or two states, something of that nature, then a lot of times a will can be good enough. What you have to understand is what the will does is at your death or demise, it will basically distribute your assets. So it tells who you want to get what. What a trust can allow you to do, however, is to kind of control the money from the grave. You can kind of set certain restrictions or parameters. If your kids are really young or don't really manage money very well, if something were to happen to you, you don't necessarily want them to inherit a large sum of money, they might not make the best decisions with it, then sometimes a trust can come into play and make a lot of sense. Same thing if you have multiple marriages or children with different spouses or previous spouses, or again, property spread out in multiple states, then each state's going to have some laws that are going to be a little different, and again, maybe the trust makes sense. So it really comes down to each individual situation. One thing that we always do recommend, however, is that everybody at least has a will and maybe a living trust, somebody that has power of attorney to you if you're unable to sign certain things, or maybe if you're incapacitated in some sort of a coma or something of that nature. You want somebody to be able to sign things, and obviously a living will help your family make some pretty tough decisions if that scenario were to ever come about. If you live in the state of Kentucky, however, we definitely recommend get a will as quickly as you possibly can. Again, each state is a little different on how they handle estates when someone passes away. And what the residents of Kentucky need to understand is that if you do not have a will, the state will provide you with a will. So actually everybody in the state of Kentucky has a will. Just if you haven't written one for yourself, when you pass away, the state will give you theirs. And you don't have to read this will, but I have, and if you were to take a look at it, it's really nothing that anybody would ever want. A lot of times individuals think, well, you know, I'm married, I don't have much, or, you know, what I do have is just going to pass on to my surviving spouse or my kids. And you would think that that would be the case, but that doesn't always work that way, at least here in this state. If you were to pass away, actually your brothers and sisters could maybe inherit part of your estate. Not all of it will necessarily go to your surviving spouse. So the way that you can avoid these types of problems, because that's not what most people want, the way that you can avoid that type of a problem or scenario is just get your own will. And again, you can download some things off the internet. You can go to some places that are fairly inexpensive. This is an area where, again, we're not estate planning attorneys, but I kind of believe sometimes you get what you pay for. You can use those lower cost options, and maybe it'll work out okay, but I would recommend go sit down and talk to a professional. Those individuals then can help out. If you were to pass away, they're going to know what you wanted, what was intended. They can keep you up to date with any changes that come along, because the laws and the rules are always changing. Some of those online services, they're not going to keep you up to date. If you want to try it, by all means you can, but I would recommend talking to a true professional. And again, if you need a reference or referral to someone that you could talk to, we have different estate planning attorneys that for years have done a very good job for our clients. We'd be happy to get you in contact with one of them.
You're on the back nine heading for the clubhouse. Your dreams of spending time with family and enjoying retirement are just within reach. What happens if you end up in the rough? In these uncertain times, it's crucial to be prepared with sound advice. Strategic Wealth Designers is one of Kentucky's premier retirement planning specialists. For a complimentary consultation, call 1-502-653-6080. Strategic Wealth Designers. Plan to retire well.
So guys, let's talk for a moment a little bit about the three competing investment worlds that we sometimes will educate our clients about. One of the questions I get often from individuals when I meet with them in the office is they'll say, Matt, you know, I don't understand what's happening. I can go talk to 3 or 4 or 5 different advisors and get 3 or 4 or 5 completely different opinions. You know, why is that? What is happening? So you want to take a moment and talk about the 3 different investment worlds?
Yeah, that's a great question. And typically what happens is if somebody goes down to the bank, they're going to be recommended things that the bank has to offer. If they go talk to the brokerage house, they're probably going to get recommended stocks, bonds, mutual funds. So whoever they're going to see, insurance guy, whoever they're seeing, they're going to recommend only the products that they have to sell. So it's always important for someone to work with a fiduciary or someone that has all of those tools at their disposal, so that if you're trying to produce guaranteed income, you can use some insurance products, or if you're using one for some liquidity, you may use the bank. So you just got to make sure that the tool you're using matches up to the goal you have.
But I thought, Jordan, that all advisors were basically created equal, right? We all have to do what's best for our clients. We all have basically the same tools in our toolbox. So why is it that, again, maybe sometimes the investment advice is a little different? Like, let's say if we have somebody that can, you know, sell you stocks or bonds or insurance products, you know, why is it that there's so many different opinions out there?
Matt, that's a great question. And there's really 2 different types of financial advisors. There's a suitability type of advisor who their investment decisions are what's suitable, but is that in the best moral, ethical, and legal interest of the client? And that's what a fiduciary is. They have the 100% best interest in mind for you, and their ultimate goal is to help you.
But isn't every advisor you talk to going to do what's in your best interest?
No, suitability, what he was talking about, is it's in their best interest to help whoever they work for. So their job is to sell whatever product their boss is pushing, or whatever product their company is pushing.
No, you're not talking about quotas.
I mean, really, that's kind of the way it works. So with that suitability standard, that's really what's going on. Where a fiduciary, he like Jordan said, he morally, legally, and ethically has to recommend only what's in their best interest.
Yes. So obviously the fiduciary standard is what we recommend those that are retired or soon to be retired, those types of advisors we recommend that they work with, and the penalties are really different as well for the advisor. Meaning, so if you work with someone that just has to work under a suitability standard, you could pretty much make the argument that almost anything that we just mentioned, stocks or bonds or CD, I mean, you can almost make an argument that all of that could be suitable for somebody, right? But do we think that somebody that's 78 years old and is retired, is it really in their best interest to have small cap stocks in their portfolio, right? So if a fiduciary, someone like ourselves, were to recommend to a 78-year-old to have small cap stocks in their portfolio, there's a really good chance that we would pay some pretty high penalties, maybe fines or sanctions, suspensions. If it's serious enough, we could obviously lose our license. And if it was really serious, in some cases, advisors can go to jail when you have to act as a fiduciary and when you don't do that. So you typically have these three different investment worlds. You can have both fiduciaries and those that have a suitability standard. You can find them in each of these three different worlds. Whether it's a bank or a stock brokerage firm or an insurance company, sometimes the advisor may be a fiduciary and sometimes they may not. So what are some things that you recommend as far as how do individuals find out, if the advisor has to do what's in their best interest? They're all going to say they're going to do what's in their best interest, but how do you know you're working with somebody that by law has to?
There's two things to really narrow it down quickly. Number one, ask, are you a fiduciary? I mean, they would have to answer whether or not they follow the fiduciary standard. The second thing is if you flip over their business card, it'll either say so-and-so is a registered investment advisor, or it'll say they're a registered representative of XYZ broker-dealer.
Or maybe even their website as well. Sometimes you can find that info. If you don't want to wait till you get their actual business card, you can sometimes look at the website or other types of marketing materials, things like that. So, Jordan, when you meet with individuals in the office, is there really maybe one of these three different investment worlds that you prefer more often than not, or are you kind of a one-trick pony, or do you typically like to operate in all three?
I like to operate in all three. There's not a one-size-fits-all hat. There's no cookie-cutter approach. So really, we have to do what's best for the client. And that sometimes can be the first world, the bank world. That sometimes can be the broker, kind of securities world. And that sometimes can also be the insurance world.
Yeah, so I think really as individuals get more and more educated about these types of subjects, the real important point we're trying to make here today is to make sure that you work with somebody that can operate in all three of these different worlds. Like Dustin was talking about earlier, if you have somebody that only has an insurance license, well, then obviously they're going to think insurance and annuities are always going to be the best fit. If you have somebody that only has a securities license, well, then they're going to think stocks, bonds, and mutual funds are the end-all be-all for everything. And all those different investment options may be appropriate for certain people at certain stages of their lives. It's usually better to work with someone that has the ability to work with any of those three different worlds. Right now, the banks really aren't too competitive with where interest rates are, but we know that'll change eventually. And when it does, you want to be working with somebody that has the ability to offer those types of strategies and options as well.
Right.
So thanks again for watching this week's show. If you have any questions about what we're discussing here on the couch today or anything that you've seen on the show, feel free to give us a call at the office and or visit our website. As always, tune in again next week. We'll be here at the same time, same place. And remember that retirement planning is a journey, not a destination. We'll see you here next week.